Hey everyone, welcome back to Corporate Decoded, the place where we break down complex financial documents into plain English with a hint of sarcasm to make sure you know exactly what is going on. In this video, we are diving deep into Triton International Limited's latest financial report, and let me tell you there are some big moves and even bigger numbers to unpack. Before we start, if you appreciate breaking down big company reports and getting straight insights without all the jargon, make sure you hit that subscribe button. We also have a fantastic community Discord server linked in the description below where we discuss these filings and more. So what is Triton International Limited all about? Well, they are the biggest player in the world when it comes to leasing out those massive metal boxes we see on ships' trains, and trucks, basically the containers that move all our stuff around globally. They own a huge fleet and lease them to shipping companies. They also do a bit of buying and selling of containers. Their financials show activity for the 9 months ending the 30th of September 2025 and 2024, giving us a good look at how things have been changing. We are going to look at their balance sheet, their income statement, and cash flows to see how they are doing financially and what risks they are facing. Let us start by looking at their balance sheet. This is like a snapshot of what the company owns and owes at a specific point in time. Here we see their leasing equipment, the core of their business. In September 2025, it was worth about $7.4 billion, a notable drop from over $8.6 billion at the end of 2024. This suggests they are either selling off equipment or it is depreciating. Overall, their total assets are down from about $11.1 billion in December 2024 to just over $10 billion in September 2025. On the other side of the coin, their debt also decreased from around $7.6 billion to about $6.7 billion. This is good news as it means they are paying down some of their financial obligations. Now, for the owners, their equity decreased from $2.8 billion to $2.5 billion. This drop could be due to a few things like dividend payments or changes in market value, but it is something to keep an eye on. Moving on to the income statement, which shows how much money they made and spent over a period. For the 9 months ending the 30th of September 2025, total revenues were around $1 billion, a decrease from about $1.14 billion in the same period in 2024. This means their top line sales are a bit lower. Their operating income, the profit from their main business operations, was $625 million in 2025, up from $585 million in 2024. That is a positive trend showing they are getting more efficient at running their core business. However, when you subtract the dividends they pay to holders of preferred stock and look at what is left for common shareholders, the story is a bit different. Net income attributable to common shareholders was $341 million in 2025, up from $314 million in 2024. So while overall profits are up for common shareholders, the decrease in total revenues is something to note. Now let us talk about cash, the lifeblood of any company. This statement shows us where the cash came from and where it went. For the 9 months ending the 30th of September 2025, cash from operations was about $723 million, down from $868 million in 2024. This decrease is a big deal, and it is largely due to a major event called the TCF-8 distribution, which we will discuss more. Investing activities are where companies spend money on long-term assets like equipment. Here we see a significant surge in cash used in investing activities from about $380 million in 2024 to over $818 million in 2025. This increase is primarily due to the acquisition of GCI, which they bought for over $1 billion. Financing activities involve borrowing money, issuing stock, and paying dividends. In 2025, they had about $91 million in cash provided by financing activities, a big flip from using $476 million in 2024. This shift is mainly because they took on more debt for the GCI acquisition and received money from issuing preference shares, a good sign that they can access capital when needed. Let us dig into some of the reasons behind these numbers. The company describes its business as leasing intermodal transportation equipment and offering management services. They are exposed to credit risk, meaning their customers might not pay them back. Looking at their customer concentration risk for the first 9 months of 2025, their top 3 customers made up 19%, 19%, and 14% of their lease billings. In 2024, it was 20%, 19%, and 12%. While not alarming, it is worth noting that a significant chunk of their business rests with just a few clients. A major event in 2025 was the acquisition of Global Container International LLC, or GCI, for about $1.07 billion. This is a big move and explains a lot of the increased spending on investing activities we saw earlier. Another significant event was the distribution of their equity interest in Triton Container Finance the 8th LC, or TCF the 8th. This means they spun off a part of their business. This is a key reason why their operating cash flow decreased and why some revenues and expenses are lower in 2025 compared to 2024. The impact of this distribution is felt across their financial statements, particularly in revenue and asset values. In terms of shareholder equity, they issued about $144 million in Series F preference shares in February 2025. They also paid out dividends. Notably, they paid $150 million in common share dividends to their parent company Thanos Holdings, limited in the first 9 months of 2025. This shows a flow of cash up to the parent. Triton has several series of preference shares outstanding. It is interesting to see the different dividend rates and liquidation preferences for each series. They raised a significant amount of capital through these preference shares. Let us look at their debt. As of the 30th of September 2025, their total debt was about $6.7 billion, down from $7.6 billion at the end of 2024. This reduction in debt is definitely a positive signal about their financial health. They have a mix of secured and unsecured debt totaling over $6.8 billion. About 83.4% of their debt is fixed rate or synthetically fixed through swaps, which helps protect them from rising interest rates. Speaking of interest rates, Triton uses derivative instruments, primarily interest rate swaps, to manage their exposure to fluctuating rates. They have a substantial notional amount of over $1.7 billion in interest rate swaps, helping to lock in their borrowing costs. This is a smart move in an environment where interest rates can be volatile. Now, for the risks, companies are required to disclose potential downsides to their business, and Triton has a few important ones. One of their biggest concerns is trade policy, especially between the United States and China. Tariffs and trade tensions can significantly reduce international trade, which directly impacts the demand for their leased containers. With political shifts and ongoing trade disputes, this remains a significant risk. They also flag the risks associated with their acquisitions, like the recent GCI deal. Integrating new businesses can be costly and complex, and there is always a chance they will not achieve the expected benefits, which could hurt their financial performance. A critical point is that a subsidiary of Brookfield Infrastructure owns all their common shares and effectively controls the board. This means Brookfield Infrastructure's interests might not always align with those of the debt and preference shareholders. They could make decisions that benefit Brookfield, but might be risky for others. This is a classic scenario where a controlling shareholder's goals can sometimes clash with minority stakeholders. So what is the big picture when we look at Triton International's latest report? Well, their core leasing business seems to be facing some headwinds with revenues down, but their operating income is up, showing improved efficiency. They made a massive acquisition, GCI, which will likely impact their future performance significantly, and they successfully reduced their overall debt, a very positive sign. The spin-off of TCF the 8 is a complex move that will reshape their financials going forward. The risks around trade wars and the potential influence of their controlling shareholder are significant, and investors should pay close attention to how these play out. They seem to be strategically managing their interest rate exposure, which is a credit to their financial management. Overall, Triton is navigating a challenging global economic environment with some bold strategic moves. The acquisition of GCI is a key storyline moving forward, and investors will be watching closely to see how well they integrate this new business, and if it delivers the expected returns. Alright, that is our deep dive into Triton International Limited's latest financial report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives like this. Don't forget to check out the Discord in the description for more community discussion. Thanks for watching, and we will see you in the next one.